Yes, we are going to talk about our favorite stocks here in this video, go over the Ortex stat of the things that we usually cover. But the stock market crash just went from bad to worse and got substantially worse here on the day. That is why the S&P is down almost 2.5% and the Nasdaq is down about 3%. So I want to get into all of this information. We do have another major catalyst coming next week, and these two things are really feeding into each other and creating a really bad overall market dynamic. So let's dive into all of this information. If you guys find value out of this video, hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section, and make sure to go ahead and get yourself that free stock with Webull, Moomoo, and Public. Now, without any further ado, let's get into this video. So what really happened today and what brought down the markets, if you guys have not seen it yet, it is the CPI report that came out today. So inflation rose 8.6% in May, highest since 1981. The consumer price index rose 8.6% in May from a year ago, the highest increase since December 1981. Core inflation, excluding food and energy, rose 6%. Both were higher than expected. Surging food, gas, and energy prices all contributed to the gain, with fuel oil up 106.7% over the past year. Shelter costs, which comprise about 1/3 of CPI, rose at the fastest 12-month pace in 31 years. The rise in inflation meant workers lost more ground in May, with real wages declining 0.6% from April and 3% on a 12-month basis. So what this report really showed, and what you can bottom line this down to, is inflation is branching out. It's moving into different asset classes. It's also moving into more of the services. Now, what we've seen the last time around, and last time around I mean high inflation, 70s, 80s, it was really in a lot of goods, right? The cost of things kept going up. Well, what we're seeing now is the cost of things went up, very, very fast, like we've seen in the 70s and the 80s, but now the price of services is also going up, and that can be very, very sticky, like your doctor rates, probably not going to go back down after they go up, right? That Disney ticket, probably not going to go down that fast. So you're seeing inflation really branching out, and what this ultimately did for the Fed is it's saying, hey, you guys probably can't stop or slow down raising rates in September. That's what the markets have been looking forward to, is, hey, if inflation comes down, if things can start looking okay, then the Fed can stop raising rates in September, or at least slow down in a big way. And that is completely off the table. That's not going to happen. Now people are talking about a 75 basis point or a 1% rate hike coming at future meetings, and that is starting to get priced into the federal funds rate, or the projected federal funds rate, I should say. Now, if we look out to December, most participants in the markets are expecting a federal funds rate in between 3 and 3.25%. Guys, the federal funds rate is currently at about 0.75%. So that would be a pretty decent move to the upside. And it's a range, so 0.75% to 1%. That's where we're currently at right now. And that would be, implying 50 basis point rate hikes as well as a 75 basis point rate hike from now until December. So we started to see the federal funds rate actually calm down and to start pricing in less. And now we're pricing in more. So what does that mean for long duration? Well, long duration growth stocks is exactly how it sounds, long duration. So if you're buying something like a SoFi, a DraftKings, a Affirm at the market value now, you're hoping that company is much bigger in the future. That is long duration growth. So when you start to get this expectation of, basically capital becoming a lot more expensive, those growth companies that aren't necessarily profitable are going to have to borrow money, and it's going to cost a lot more. At the same time, it looks like inflation is going to be higher for longer, so that also drives down the real potential profits these companies will make in the future. It makes the dollar less valuable. So really not a good situation overall for long-term growth stocks. And why it's going to be so interesting over this next week or even the next couple of weeks is where the markets are at, as well as the catalyst for next week. So if we look at the S&P 500, it was definitely a gap down almost 2% here on the day, coming to the lower end ranges. We have not closed this low too many days. You guys can see the wicks are pretty low, but the closes here have not really been in the low 390s. We closed right here at 389, and we had hit that low at 380. We closed right here at 396, closed right here at 393.89. We have not closed at these levels yet here in 2022, besides right here, and that was on May 12th. We actually did close at 392.34. So we're approaching the lowest closing price on the S&P 500 of 2022. And that's not going to be a good sign. If we sell off into the end of the day, the last couple of minutes here, that's going to be no bueno. So you're in a really weird situation as far as actual price action on the S&P 500. And then we have the Fed meeting coming next week. The Fed meeting is in 5 days, 49 minutes from now. And that will be on June 15th. That falls next Wednesday. So I think, Monday, Tuesday, those could be pretty fearful days in the markets. I would expect a little bit of a bounce back, but if we sell off into CPI, or not CPI, but the Fed, we might get a bounce. But depending on what the Fed says, if they just come out and raise more aggressive than 50 basis points, or kind of tell us they're not going to slow down, the markets might have a little bit of a fit over that. Now, as well as that, if we do go ahead and look at the bond yields shot up today in a very dramatic way. The bond yields are now at 3.15%. That is up 0.1% on the day. That is a colossal bond move. That does not happen. Normally, that does not happen. This looks like a momentum stock. Just yesterday at 3.04%, you're now at 3.15%. It's a massive move. And it's definitely going to push the price down of especially a lot of growth stocks. So that's what is really happening today. Bond yields destroying the markets. CPI destroyed the markets. And I think there's this expectation that the Fed might rug pull us, and that could also destroy the markets for next week. So that's really what we have to contend with. That's going to be the main catalyst. That is what is happening. We'll dive into other things that can affect the markets, over this weekend, and really try to figure out what potentially is the most likely outcome for these next couple of weeks. But it doesn't look pretty right now. It doesn't look pretty at all. You're starting to see layoffs. You're starting to see companies cutting guidance. At the same time, inflation is high. The Fed is raising rates, heading into recession. It's almost a perfect storm for not only volatility, but the market's staying down for a considerable amount of time. So before we switch topics and talk about our favorite stock, I want to leave it off on this one word, because that was a lot of negativity just brought to you guys in a very short amount of time. Take this opportunity to solidify your long-term future. If you are over here buying the dip in quality stocks that will make it through a recession, you can come out on the back end of that with a massive position in some of these companies that could balloon for you. And that's what I want to see happen. So at least for you guys, if that's what you want. I mean, if you're watching this video, hopefully you want to make some money. But nonetheless, let's get into the other information we have to cover about our favorite stock here in this video. So now let's talk about SoFi stock. And the stock is down about 2.3% today, which is actually not bad considering the move in bond rates that we are seeing. And that is pushing up the interest rates for any kind of SoFi product that you wanted to get, thus decreasing demand for those same lending products. So it's actually quite a bullish thing. The stock is only down about 2.5% on the day, believe it or not, but we are slightly under $6 per share, still in this range, really in between, what we've been trading at, in between about $8-ish and about $5-ish. We're still off the lows by about $1.28. per share. So we're not at the lowest end point, but if we do get some more continued downside momentum, you want to watch that $5 level flat. I think that is a really good level of psychological support, and I've got some questions about what psychological support actually means, and it's literally exactly what it says. $5 key support level. If you broke under 5, 4, 3, those would be key support levels just psychologically, just like resistance levels. $10 is going to be a psychological resistance level. It's just where a lot of orders are going to go through and where a lot of people potentially get stopped out of trades, so on and so forth. Hopefully that cleared the air for some people on that. Now, if we do go ahead and pull up SoFi on the Ortex platform, we will go ahead and see that the short interest of free float is sitting at 16.81%. Current shares that are sold short of 122.3 million. Cost to borrow max at about 5.1%. 100% utilization. Days to cover at 3.77. Free float out on loan about 26%. So a lot of shares that are out on loan that can be used against us. But overall, just the shorts have taken over. But not even necessarily just the shorts. I've talked about this many times. It's really in the option activity as well. You are seeing some massive put options that are heading onto the option chain that is helping to push and keep SoFi stock down. So that's definitely not a bullish thing, and it's not helping to rally SoFi stock. Look at some of these orders: $10 million, $4 million, $4 million, $4 million, $4 million. You usually don't see option activity like per order in the millions for stocks that are such a low market cap, right? But for some reason it says interesting flow sentiment, 5 orders totaling $7.82 million, positive order value of 99% as of today. So pretty interesting. I'm not quite sure why it says that, but still it's not good all around. And we did see a lot more buying from Anthony Noto yesterday. He did buy about 47.63 thousand shares worth about $300,000. This guy is buying the dip like nobody's business in SoFi stock, and I think that is a very good sign. If you wanted a sign, forget anything, if you wanted a sign that your company is doing good, it's insider buying, especially when they're just dollar cost averaging every single day, almost every single day, with a brand new order like Anthony Noto is doing. It is a very, very strong sign. Now, that is pretty much going to be all for this video. The MACD is bearish. The RSI extremely bearish. You could definitely see a rally at any moment, but with this big fear catalyst coming next week with the Fed, potentially could be one of those events where you sell off into the Fed, you rally after the Fed, or you sell off into the Fed and then you sell off more after the Fed if the Fed does change something around, something that we are not expecting. That is always a possibility. Be mindful of that. But that is all for this video. That's what you guys need to know. Hopefully you learned something out of this video. If you did, give it a thumbs up, subscribe to the channel. Thank you guys. Get your free stock down below in the description with Webull, Moomoo, and Public. But until next time, you guys enjoy the rest of your weekend. I'll see you in the next one.